Hello everyone, George DeSantis here with a look at the market for the week ending Friday, January 24th, 2020. And the usual procedure is that we bring up a disclaimer. Take a look. It simply states that I'm not a professional investment advisor, and I do this for my own purposes and put it on YouTube so that anyone can take a look if they wish. But it's not an attempt to give investment advice. Let's begin by looking at the market with the weekly chart of the S&P 500. So here's a weekly chart of the S&P 500. Um, the first thing I usually do is look at the moving averages, the exponential moving averages, the front-weighted moving averages. So we have a 4 exponential moving average here, the yellow line, above the 9 exponential moving average, this magenta line. And that is above the 30 weighted moving average. So insofar as moving averages are concerned on the weekly chart, we have an uptrend. We have the parabolic below the most recent bar, and it's been that way for some time now. So that's indicating to us that we have an uptrend. What we can notice here too is that the week before, that weekly bar hit the 2 standard deviation line. So it was sort of expected that we would have a bit of a pullback. Now, when I say this, I'm ignoring all the geopolitical concerns of the virus in China, the impeachment, everything else. We're just doing technical analysis. And we're assuming that all that is built into the charts. Maybe a wrong assumption, but we'd have to do that. So what we have here on a weekly chart is we have a, a bullish harami, or pregnant woman as sometimes called. You have the body of this bar totally engulfed by this bar, the body of this bar. That is bullish. So insofar as the weekly chart is concerned, we have some bullish indications. Parabolic, moving averages, harami, bullish harami. We are still in that area close to the 2 standard deviation line. So we get a little volatility there. Now, if we go down to the other indicators, we can see that the MACD histogram is still above the 0 line. So it's in bullish territory, as it said. Insofar as Williams percentile is concerned, since it became bullish back here, somewhere around January, late January, it's remained above the magenta line, the minus 50 magenta line. So that's still indicating bullishness on the Williams percentile 30 period. As far as the Jerry Appel's sum of the rate of change indicator is concerned, it's still above 4%. So as far as that's concerned, we still have a bullish indication here. So let's look at the daily chart. All in all, this looks pretty bullish still. Oh, before we go to the daily chart, what I did was put in the drawings of the inverse head and shoulder pattern that I've observed. So what we have here is the head, the shoulder, this yellow line, the head here, a shoulder here, and that's the neckline. So what I did was calculated the expected target from this inverse head and shoulder, and what I come up with is 3573. So that's the target we can shoot for in the future. 3573 is somewhere up here. So that's also bullish. But let's take a look at the daily chart. Now on the daily chart, slightly different picture, shorter term, etc. So what we have is the 4 exponential moving average beginning to trend down a bit and not quite below the 9 exponential moving average, but it looks as though it might cross that. In addition to the moving average, the displacement here of the 4 and 9, we have a bearish engulfing candle. This body of this bar totally engulfs this bar, the body of this bar. So that's a bearish indication on the daily chart. We also have parabolic, these dots above the most recent bars for the last 2 days of trading. So the daily chart is showing us the indication of that pullback that I mentioned we might get because of the um, bearish divergence of MACD. So let me pause and draw in the bearish divergence again. So you remember that a week ago, 2 weeks ago, I pointed out that we have a bearish divergence of MACD because as the market made a higher high, MACD made a lower high after the bears pulled the bulls down here and broken the back of the bulls. So we were anticipating a pullback, if you recall. I was anticipating that, and that's exactly what we had last week. Last week we had this pullback. Now we have a bearish engulfing candle, which I think I mentioned before, so we won't go into that again. But this is where we are now. With the bearish divergence, we are correcting. What's interesting here is that you will notice that we closed between the 9 EMA and the 30 weighted moving average. This is usually a buy zone, according to Rick Monteith of eFuture Vision, using the 930 system. So we are now situated in the buy zone. So that would be consistent with the fact that the weekly chart looks very bullish, and we've had a bit of a pullback on the daily chart to confirm this bearish divergence of MACD. Whew, that's in a mouthful. Now we can take a look at the Ishimoku cloud, the chart with the Ishimoku cloud, and what you'll notice is that the cloud is indicating higher prices to come. This is what this cloud indicates here. And although we have this bearish engulfing candle, we're still way above the cloud. So this is pretty a good indication that we're still in a bullish mode. Now last week we looked at this chart. This is a best choice chart showing the regression channel. And last week I pointed out that we were at overbought levels here for the last couple of weeks at least. But we were at overbought levels here, and now we're pulling back. Let me get rid of the crosshairs. Now we pull back a bit for the last few days last week. We pull back. So now we're at 69.5 instead of 90, which is what this yellow line is. But we still have a very tight range here, and this looks as though we might bounce off of this middle line, the 50% line, which would be around 3250 if we get there. Here's a chart of the new high, new low index, and you can see that it's still well above that 50-day moving average and that 200-day moving average. So insofar as the new high, new low index is concerned, still pointing to higher prices with a bit of a pullback here. Here's a weekly chart showing the impulse system that Alex Elder created, and you can see we now have a blue bar. A blue bar tells us that we can go either long or short. But since these moving averages look so bullish, I wouldn't attempt to short this market here at all. So I'm leaning on the bullish side, of course. And here's our chart of the percentage of stocks of the S&P 100 above their 200-day moving average. It trended up very nicely here, and it's pulled back and it's sitting right at the 50-day moving average. We'll see if it holds here or if it goes any lower. Now, as we continue to look at the general market, the S&P 500, here's the SPY, which is, of course, the ETF of the S&P 500. And what we can see here is that the S&P became overbought, as we saw with Best Choice. So on shaking, it also became overbought and is now ticking down. So that's another indication that, yes, this market was overbought and it's taking a breather. And you can see it was rallying up on that upper channel line here. So it's pulled back a bit, taking a breather. Look at the other indications. Money flow is still pretty strong. This is an ETF, so it's still bullish. And if you look at the relative strength versus the Russell 2000, you can see that it's still in bullish territory or positive. So now last week, I think I sent you guys the link to this site where you can see the performance of the ETFs of the SPDR ETFs. There are 11 sectors, and you can see how they perform relative to each other. What I like to do is every 3 months or 6 months, doesn't change much in that time. But I like to see what are the leading ones. So the leading ones here are communication services, up 11% in the last 3 months. XLV, which is healthcare, and XLK. Now, I use the analogy of a horse race. I want to be buying these horses that are leading in the race, especially if it's a sprint. So I own these. XLK is up 18%, 18.9, XLV and XLC. And of course, XLU is now beginning to perform well because XLU is the utilities which usually does well within the first 6 months of the year. So if you don't have this link, it's easy to get. Just go to Spiders up here, spiders.com, and put in this link and you'll find it. And I find it very useful. And if you're interested in seeing how Shaken rates the ETFs right now, you could see communications, technology, utilities, healthcare, and of course the general SPIDER. And here's that watch list that I've brought up before. Here's Accenture. I don't own it right now, but it's one that I keep an eye on. You can see that it's still trending above that 200-day moving average. Money flow came down a bit, but it's now overbought. In fact, one of the things you'll notice with many of these stocks now is consistent with the general market. Many of them are indicating that they're overbought, near this 70% line here. So let's see a few others. BMY I sold. I did sell it somewhere in here, but I saw it going down, so I sold it. And I didn't like the fact that the money flow came down here. iPay I still have. That's the payment systems. This money flow seems to be increasing again, but again you could see overbought. Microsoft, same thing, overbought and coming down a bit, but it's still a stock that I own and I will not sell it right here. XLK is that one we were looking at, that ETF. You can see it's overbought. Even the XLK is overbought. So general market needs to take a breather here. As Larry Williams used to say, the market needs to breathe. It's like an athlete, you know. Adobe is also been trending up nicely, but taking a little bit of a breather perhaps, you know. CDNS, now I used to own that a while ago, and then it fell out of favor here. And now it's starting to trend up again, and it's above the 200-day moving average, and it's changing its personality, the Shaken people would like to say, you see, because it was very positive here, became negative, and now it looks to go positive again, and it just changed to bullishness, to being rated bullish rather than neutral. So that's one I'm going to keep an eye on and maybe buy it again. Google, we can see that Google was overbought too, but relative strength is high and it's rated bullish. This one, this IHI, I don't own it, but it's a healthcare tech. It's a company that manufactures these medical devices. It's actually an ETF of companies that manufacture medical devices. It's still trending up nicely, pulled back like with everything else. MasterCard, of course, what can you say? MasterCard keeps trucking along. Southern companies, electric utilities, starting to do well again. I mentioned last week I used to own it and then I got rid of it for some reason. I wanted to buy something else. I think it was Tesla, so I sold it. Bought Tesla. It was not a bad choice. And look at it, but look at Southern here. Look at the money flow. It's overbought, but it has a nice dividend. Let's see what else you want to look at. How about Apple? Apple keeps trucking along. Visa, how about Visa? Visa likewise became quite overbought and pulled back a little bit, as we saw with so many of these other things. I don't have PayPal anymore, but it's one that I loved, and then I got rid of it when it started to do this thing here. But it's now overbought, so I'm not buying it back here. Tesla, I own quite a few shares again, and we'll see where it goes from here. Well, that's it, folks. We ran out of time. We only have 15 minutes for this. Hope you have a great weekend, and we'll try and do this again next week and make some walking around money, right?